The agenda for today is going to be similar to the other ones that we do. We got the market update, so we're going to brush through some of the things that we've been talking about internally and from the sense of where we are in the market. We're going to go into a real estate outlook with our special guest, Donnie Anfuso, MP4L. And then we're going to break this open for a little Q&A. Now, at any point you guys have a question that you want to have answered, throw it into the chat room, and I will make sure that we are reading them off and we're keeping everything on pace, because we don't want to make this for too long. So if I don't ask your question to the group immediately, I'm just waiting for the right time. So please make sure that you're getting them in there, so this way we can get them teed up and ready to go for everyone else.
Yep.
All right, Sean, let's go. Or who's running? There we go.
Wanted to give you guys a review of the market vitals so far in 2024. Obviously, there's a lot of numbers on this page right here, but we want to break down a little bit about what they mean. So the S&P 500 so far this year up 16%. Just in the last month, it's up 3.5%. So really just same thing as last month. It's been a strong market. Equities continue to rise. As we get down to this treasury rate, we see in the last 1 month, the 10-year treasury is actually down. And a big part of that is because of the soft inflation print that we saw come in. So inflation came in at 3.3% for this month, when 3.4% was the expectation. So what does that tell people? Potentially rates being cut sometime in the near future.
So Sean, what do you think of the driving markets with the S&P 500 from last month to this month? What do you think is still bringing that market in an upward trend?
I think a lot of it is just the news cycles that we've been seeing, the earnings that we've been seeing out of companies. If we just look at Adobe last week, up 15% off earnings. Lululemon was up 12% off earnings. So despite the treasury rate being high and interest rates being high, the economy has just continued to be strong, and it's showing in the numbers. And the fact that these companies are continuing to show big profits, big revenue increases, has just continued to bring this S&P 500 performance up to this 16% level.
It's funny because we mentioned interest rates high, and this is a normal sort of rate cycle, right? This is, with exception to, to the low interest rates we've been seeing. This is more of a historically normal number. Yeah. So I think some of that fact of interest rates aren't going to be going down so quickly, like people assumed a year and a half ago, or even 6 months ago, is normalization of this market, right?
Definitely. I think one more thing to mention is if we look at bonds as opposed to equities, which are up 16%, the Barclays aggregate bond index is currently down minus 0.5%. So it's down 0.5% so far this year. So not having the same success that the equity market is having, and it's because of that interest rates, that high interest rate. But yeah, Brandon, what are you seeing in terms of sector specific?
Just to clarify for everybody, he's talking about the Barclays Ag, and that number is for the 10-year treasury. So that's the difference that you're seeing between the 10.14%. The Barclays Ag, which is more of an index that tracks the corporate bond market, is what he's saying is down about 0.5%.
Yeah, thank you for that clarification.
Something with the sector specific ETFs. I think it's just important to note, technology is still outperforming, up about 21%, but also taking a look at the other sectors like healthcare, energy, industrials, or the financials, and just looking, they are doing pretty good this year too. Not so outperforming like technology, but something to just really take note of and continue to watch and see how they perform, throughout the second half of the year, and really just observe any changes in the market or in those specific sectors, and even taking a deeper look of what's really driving those sectors to be doing so well. So really just something to keep an eye out, as the year continues on and how those things might change.
Yeah. So you'll see a lot of the risk on assets are what really outperforming here.
One quick thing, and this is actually something that we were talking about before with the two. One thing that's new, by the way, for the investment committee is we have 2 interns with us this year, Kelly and Devin. They've been absolutely awesome and great. And we were having a quick discussion about interest rates and why the market seems to be doing so well in the face of high interest rates. And there's something on this page that if you really start to unpack is kind of hidden in there. And that is really in that major index performance, that top right table that we have. You see the Russell 2000, that tends to be smaller companies, is barely up this year. And the S&P 500, the NASDAQ 100 tends to be larger cap companies. And so large cap multinationals killing it, small caps not doing as well. And they are more sensitive to the interest rate changes in the United States. Now, I'm not saying that as like a fact. I'm just saying that's what we're observing. And part of the reason may be, and I don't think this has been, proved out and is part of a postulate, but one of the theories floating around is large cap companies can take advantage of low interest rates in other domiciles. So Japan still has near zero interest rates. Europe, lower interest rates. So they can go out and take their international arms, borrow money over there, and kind of move it to US investments. And that's one reason why international companies, they can look at that global landscape where if you're a local smaller company, you got to live with what's available in your domicile. So that's something else that kind of seems to be taking place. And always keep in mind, if there's arbitrage opportunities, larger companies may be able to take greater advantage of those than some of the smaller companies. And that seems to be what might be playing out here. Sorry for that kind of long dissertation, but I think that's important just to throw out there.
No, it is, and it's less of a I would say they have less of a market kind of debt structure than the smaller cap that has to go to market in a different way. They also go to market in a different way to raise debt.
Mm-hmm. Yeah, I think one last thing to kind of mention on this page, India ETF up about 17% so far year to date. Mexico ETF just about flat. So these are two countries which are having large elections this year, in addition to the US. But that's something that we will also touch a little bit more on the next slide when we get into our news stories, which I will bring us to now. So a couple recent news stories. The ECB, which is the European Central Bank, and the Bank of Canada have actually begun cutting their rates. Bank of England is expecting to start cutting their rates again in August. And obviously that's something that everyone's kind of been waiting for the US Federal Reserve to start cutting rates. Started at 6 was the expectation this year. As of their last dot plot, the Federal Reserve, it was a split between 0, 1, and 2 expected rate cuts for the remainder of the year. So right now, September is really what everyone has their eye on in terms of that first rate cut. We will see if that ends up happening. And it's really been because the US economy has been a lot stronger than those other countries. They're starting to cut rates now. We are just hanging on a little longer with those rates paused at that high restrictive level of about 5.25 to 5.5%. And they're likely to keep that higher for a little bit longer. That's why we've seen that expectation fall from 6 down to 0 to 2 rate cuts for 2024. And then another news story is that election year story. 64 countries this year are holding an election. So it's not just the US. About 49% of the world's population is undergoing an election in 2024. And two of the big developing markets that we've seen be impacted by this is Mexico and India. So Mexico, there's just a 10% decline in the Mexican stock market because of Morena's victory, which really drives fears of her potentially changing things in the Constitution. And that's just sparking uncertainty, sparking fear. That's something investors don't like. So that really just caused that decline this month. And India took a big hit for about a day or two when Modi, who's a pro-business leader, he lost the majority. The Indian market reacted very volatilely for 2 days, went down 7%. And since then, it's just rallied right back up to new highs. So overall, it didn't have too big of a long-lasting effect on India, but these are just two countries that are going through big elections, and their markets have been reacting based on those news stories.
Yeah, I think if we just hit the, for a moment, kind of digest what does this all mean? Obviously, if you've been living under a rock, you might not know that we have an election coming up this year for president in the United States. And it is, if you were to watch the news, it's basically either the end of the world or the beginning of, new greatness. How the market's going to react is kind of unpredictable. In this particular case with Modi, it wasn't he who was up for election. It was, members of his party and in National Congress. There seemed to be a little bit of a negative reaction to some of his policies locally. The market dropped, but then was kind of like, yeah, it's going to be more difficult for him to, get his stuff around, but maybe that's healthy. But the initial response was very negative, and then, oh, maybe it's a good thing that there's some, it's not all one party kind of controlling. In Mexico, it's strangely gone the other way, where the assumption is that, some of the rule changes in Mexico could end up really hurting their economy over the long term. I actually think that this is a moment in time where the market got nuance right. And that to me was kind of a good sign. It means that the market's acting rationally, but it also means that you kind of have to be a little bit aware of what's going on and make an adjustment. For us, when we saw the issue with India, we did actually make moves to buy up Indian ETFs, ETFs that hold baskets of India stocks at that moment because we thought it was a nothing burger. We did not get involved in Mexico, not because we necessarily felt one way or other about the politics. We just didn't think that it was part of the bigger picture that we're trying to benefit from. So that's kind of the same thing, I think, with what we're going to look at with the US market. A lot of people think you need to predict who's going to win the election to understand or know directionally what's going to happen. I don't think that's necessarily true. I think there are parts of the market which will be impacted. Healthcare is kind of one of them, right? There's very different policies at play with respect to healthcare when you look at the two different parties, but it's not going to really change NVIDIA's future. I don't think AI is going to see a totally different path based on who's sitting in the White House. It's still probably going to be something businesses are interested in and putting money towards. So that's really, I think, the lesson from this is focus more on those bigger, longer term things that don't get significantly swayed by political cycles, that are more about systematic economic cycles. And that's a better way to navigate an environment where we've got so much political uncertainty kind of flying at us. Does that make sense? Does everyone think that seems like a reasonable thing to say, or?
Well, I think if you move the slide forward, we're going to start to get into a little bit more of the individual dynamics. So, no, that's the one after that. All right, never mind. Go ahead, ask that question. I guess it's the next one.
I mean, this is a little bit of the mindset of the bulls versus, the bears in the market on different topics. So even if you're just looking at the economy and you even just, see news headlines and articles when you're on, Barron's or, any website, sometimes you're going to see, it's going up, the AI boom is here and things are, looking really positive. And then you might also see an article the next day saying, the economy is going to go down. It's a house of cards. It might all fall apart. So it's really kind of trying to decipher in a sense of what makes the most sense between some of the data versus some of the articles you're reading and things like that. So I think that's one of the more important things to highlight just from that specific topic. It also kind of gives us an indication too, when you're looking at it, that everyone's not leaning in one direction or the other. Everyone's not saying it's all, going up from here. And also not everyone's saying it's all doom and gloom. So kind of trying to siphon through some of the, information while also looking at the data, can be really helpful to come up with a more, thoughtful response than just seeing a headline and kind of running with it.
Yep.
I'm sure, Jordan and Bobby, you guys can go into a lot more depth in some of this too. And Sean, I don't know if there's anything you want to add.
Yeah, I would just say that the fact that there is that dichotomy right now of the bulls versus the bears is part of why we think we're mid-cycle. Typically, when there are no more bears left, that's when it's all bulls. The market will probably be going up. And then when there's no more bulls left, it's all bears, all bad news. That's when you'll typically see it go down. So that dichotomy of having both of those parts of the news cycle is kind of just pointing to the fact that we're in the middle of the cycle right now.
Yeah, I think that's generally, what what we're hearing as we talk to people is people are unsure. And unsure usually means the trend will move on. And when people become too sure in one direction, that usually is a time when things will potentially reverse. There's a healthy amount of skepticism out there. There's a healthy amount of optimism. And when we look at some of the metrics that we follow, it doesn't seem to us like anything's superly over hot. One way or the other. One thing that some people might complain about there is they might say, well, what about stock price valuation? As NVIDIA, now crosses into the over 3 trillion mark and is a stock that, everyone from my physical therapist to the person who cuts my hair to, the person who opens the door for me at Petco will ask, what do you think about NVIDIA? There's a lot of positive story there. And at the same time, you've got very large cap companies that are trading at like 5 times earnings. So you've got both things out there. They're just in different parts of the market. And that's kind of what it looks like normally about this point in the cycle. So we just want to remind people it's seems kind of like the middle of the game right now.
All right, head to the next slide. This is just something super interesting that we wanted to highlight to you guys. 3 companies, Microsoft, NVIDIA, Apple, just those 3 companies have overtaken the market cap of the entire Chinese market, all the Chinese listed stocks. So you can kind of see the trajectory of those 3 stocks in this white line versus China's market. We've reached that point where there's the crossover, which is just pretty insane that 3 companies can overtake a country as large as China. Just something interesting that we wanted to point out to you guys.
Combination of how good they've done and how bad China's done since COVID.
Yeah.
True.
Yeah, you can really see like the highlight there is starting at 2023 of just really the trajectory upwards there to kind of meet it.
Mm.
Well, people like consistency and predictability, and China doesn't provide either.
Yeah.
Yeah.
And more so Microsoft and Apple are providing it. I don't know if I'd say NVIDIA is providing consistency, but I think we can all agree that we've heard the word artificial intelligence uttered once or twice in the last year or two.
Definitely true. Becoming the buzzword of the year, or of the last few years, really. But yeah, let's get to the main event.
ET.
I recognize that guy.
All right, so combining over 2 decades of mortgage industry and expertise with a committed to call it. Oh my God, I can't speak today. Donnie's been our mortgage professional for life for a number of years now. We've been working with him as a firm to introduce him to clients, and his understanding of the markets, his understanding of not only real estate but interest rates, the way that he follows trends, the way that he helps clients when interest rates are moving and they need to make decisions based upon a purchase of what will be one of their biggest, if not biggest, purchases of their life. Donnie's always there, even just to lend some bit of advice. It's not always about the sale for him. So, we've created quite a relationship with him over the past decade. You can see some of the statistics in terms of how much money he's facilitated, and a little bit about him on the slide. I'm not going to read it verbatim because obviously I screwed it up in the beginning, but I do think that this is a really good opportunity for him to share some of his pearls of wisdom and give us a little bit of an idea of what he's looking at within the real estate market for 2024 and some of the experience in the market that he's had over the past, let's call it 6 months to a year, with inventory being really constricted and interest rates, moving in an upward direction and kind of staying up higher for longer. So without further ado, Donald Anfuso, our mortgage professional for life. This English thing is not working out.
Wow, you totally botched today, but thank you so much for having me. You would think we didn't even know each other. Yo, Sean, could you just allow me to share my screen real quick, bud? It says I can't share my screen.
Yeah,
Just make him the host. Donnie Anfuso, the hostess with the mostest.
all right, you should be good now, Donnie.
There we go.
See if we get this going. Let me know. Can you see my screen now?
Yes,
Yeah.
sir.
Sure can.
All right, awesome. Thank you, guys. So, real estate in 2024, looking for opportunity, I thought was the most fitting title, and I figured Captain Jack could help us along the way. It's been a crazy year for real estate, anxiety, stress, projections that aren't coming through. But what I like to do is I like to focus on the positive constantly and give my clients all the information they need to make the right decision for themselves and their family, and kind of tune out all the other noise out there, because regardless of what the market's doing, there's always an opportunity out there. So let's jump right into it. Bobby stole some of my thunder here on the interest rate conversation early in the webinar. He said normalization. So this is just a great way to kind of take it all in. If you look at interest rates from 1950 to 2000, they ranged a lot, but 6% was the average interest rate for 30-year fixed rate mortgages in that 50-year period. Then we get into early 2000s, and you range anywhere between 6 and 8%. And then we had the Great Recession of 2008, 2009, and that's where mortgage rates began to drop a little bit below 6, getting closer to 5% at times. Then we had post-recession recovery between 2010 and 2019, and that's where you saw 30-year fixed rates range from about 3.5% to 5%. And that was with the help of a very accommodative Fed. The Fed was buying a lot of mortgage-backed securities, which artificially kept rates down to help boost the economy after the Great Recession. And then we had COVID in 2020 and 2022, where you saw fixed rates go from 2.5% to 4%. So when you look at rates over time, we're probably around 6.75% today. Relatively speaking, that's a pretty decent rate. It's not high, it's higher than we're used to seeing in the past 10 years, but you also have to look at why we saw those low rates. The Great Recession was one reason, post-recession recovery, and the reason why I have the great one up there, Michael Jordan, is I like to say that Michael Jordan is an anomaly, and these rates were an anomaly as well. They may have been low for too long as well, and maybe contributing to the inflation that we see now. But the idea is we have to get out of the mindset that 2 and 3 and 4% is the norm, because it's not the norm, and it's not likely we'll ever see it again. Nothing's impossible, but we have to start thinking normalization, as Bobby mentioned earlier. Now, there's been plenty of forecasting out there. These were the market odds on a Fed rate cut as of December of 2023. And if you just look down the numbers here, as of June 12th, which has already passed, the market odds were 100% that we'd see a rate cut. We have not seen a rate cut yet. And it was a 56% chance it was going to be a 50 basis points rate cut. Nothing. July 31st, we're still at 100% with a 91% chance of 50 basis points. I took this great picture of Joe Pesci in the movie Casino. I don't know if you remember that. He's throwing the cards back at the dealer. He did not like the cards he was getting. He used a little bit stronger language that I'm using here than take your odds and shove them. But I thought it was a great indication of, listen, you can't forecast anything, and timing the market is a fool's errand. I love what Jordan wrote this past week in the highlights, the email he sent out. He said that we don't find it very useful to guess the Federal Reserve's next move. Instead of trying to guess the next move, we think it more beneficial to focus on the more core items at hand. And that's what I try to tell my clients too. We don't control these things here, right? Let's focus on what we're dealing with, so we can come up with a plan that makes the most sense for us, whether it's real estate investing or investing in the market. So, oops, sorry guys. Realistically speaking, this is reality check time. 30-year fixed rate mortgages for this year, we're probably looking mid-5s to high 6% range. All right. If we get under 6%, that's going to unlock some move-up buyers and have people have an easier time of parting ways with the 3 and 4% mortgages for upgrades or downgrades, whatever it may be. And for a 10-year treasury, we'd like to see anywhere between 3 to 4.4%. Once we return to more normal spreads, that could cause mortgage rates to drop a little bit further. So we'll keep our fingers crossed. But I think these are numbers that we should keep in the back of our minds, just to keep a realistic outlook on what to expect going forward. All right, letting rates dictate, I say it's like paying interest on procrastination. What we have here is a property in Caldwell. This is an actual listing right now. The house is listed at about $599,000. It'll obviously most likely go for over asking price, but for the purposes of this slide, let's just assume it sells for $599,000. We have a lot of clients right now that are sitting on the sidelines saying, I just want to wait for interest rates to come down. That's their strategy. And this slide kind of shows you why that may not be the right strategy. You have two different scenarios here. You have a 6.75% 30-year fixed rate option where we're at today, and you have a whole percent assuming next year rates drop to 5.75%. You're losing a benefit around $21,000 with that strategy, and the reason why is you're forgetting about the most important thing in the room, not so much interest rates, but appreciation gain. That 599 house is going to appreciate around $26,000 by next year. What we do is to kind of put everything to perspective. If you waited a year, yeah, you may save $1,680 in monthly payments come the next year. And even if you refinance low rate $4,000, this is what you end up with in your corner. So waiting for interest rates, this basically shows that waiting for interest rates to drop is not the smart decision to make. And it's very important, especially for first-time home buyers or new investors, to be able to illustrate this in a way that they can understand it. So they understand that it's not as simple as just saying, hey, listen, we're just going to sit on the sidelines. Also sitting on the side. Yeah, bye.
No, I was just going to say, I think one of the things that we should highlight here also is, actually two things. Number one is we always say your primary residence should not be looked at as an investment. It's a place for you to live. It's a place for you to maybe bring your family up, whatever the case may be. It's not really an investment opportunity. And typically when you're looking at, well, you shouldn't treat it like an investment opportunity. And it really depends on where you believe the market to be. So if you believe that the market will continue to raise in value, knowing where interest rates are today, then it does not make sense to sit on the sidelines, right? But if you think that there's an imminent crash coming, why are you buying real estate anyway? You shouldn't be buying it at all then, if that's the case. If you're going to wait on the sidelines because rent is cheaper or because you have another alternative living situation, then why are you buying if you believe it to go down? So if you're only banking on interest rates going down, that's where the catch-22 comes, right? What's the bigger picture versus just focusing in on the interest rate? So you have to have an opinion on the market in terms of which direction it's going to go. And I love how you laid out the alternative here. It's very thoughtful.
Yeah, and going to what you said, people talk about housing crash. This is a great slide. This is from Kay Schiller, betting against the champ. Housing is 73-7-1 since 1941. So you get a lot of people out there that feel like prices have been going up so much, it means that there's a crash ahead. So let's look at history. 1943 through 1947, prices up compounded 118%, and prices went higher for 43 straight years. 74 through 79, prices up compounded 93%, then prices went higher for 10 years before only going down 1% in 1990. And then we had another 14 consecutive positive years of appreciation.
Hey, Donnie,
Do
you have wage inflation to match that up against?
I could do that at a later date, but it's an interesting one to do. But I'll get that out to people if they want to see that. It's pretty interesting. I don't have it here today. Right here is where people tend to focus the most on because it's what happened. It's what we remember most recently. So that's why we say everyone focus on 2007 to 2011. And here's some of the key factors to remember about 2007, 2011 for people that are so stuck on that. The housing market performance from those times, it was driven primarily by inventory, demographics, and lending standards, which are no longer prevalent today. When we talk about inventory, all-time lows in inventory. So two words here that are super important to understand. Formations, which is creation of a new household. So basically, like you're living with mom and dad, usually around 30 years of age is the age that they track this at. You end up moving out and you're going to live on your own household. That's called a household formation. And completions is construction or completion of housing units that are ready for those people to move into. And what you could see during that time period of 2007 to 2011 was formations, completions were outpacing formations significantly. I mean, right here in 2007, you had the most completions in history, and these are in the millions here. And normally, you should have it even. And if you notice, this is what caused that influx of inventory that we had and all that speculation. On top of that, lending standards at that time basically dictated that if you just had a credit score of 600, you could buy a house with 100% financing. And everybody thought that they were going to become rich investing in real estate with very to little money in the game. So you had too much inventory, you had a huge discrepancy in the demographic, and then you had lending standard that we're just not cautious at all. And if you notice, going forward to where we are now, we're getting more formations and we're getting household completions, which is going to exacerbate the already low inventory problem that we have. So when you're out there in the market and you hear someone say, "Oh, there's been a couple new houses that came on, inventory is getting better," it's just a small pocket. It's not inventory overall. To create the amount of inventory we need to make up for those shortages would take a very long time. It takes almost 6 to 8 months to build a home. So it can't happen overnight. You're not just gonna have a bunch of people that put their homes on the markets. Remember, when people put their homes on the markets, it's not necessarily inventory if they're buying another house. It's basically, you know, their house is going up for sale and they're taking a piece of inventory. It's a wash. So you have to keep that in mind.
What's interesting is, you know, you have a lot of people that are holding on to their existing homes because of their low interest rates and their low carry of costs, you know, with interest rate being low. So as these interest rates start to go down, it would still have to go down dramatically to get people off of the sidelines of staying with their current residence to go to something bigger if that's their main driver.
We believe that once they get under 6% is the thought process of the market now, people will start thinking about it more than they are currently.
Donnie, you talked a little bit about recency bias and thinking about 2007, 8, and 9 crashes being prevalent. But the other thing that another psychological bias that we see in markets is anchoring, which is people start to anchor towards numbers and they get used to that number. How used to these higher interest rates do you think current buyers are now that it's been about 2 years or so where we've been above 6%?
I wish I could say a lot more than I wish I could say that they were getting used to them more than they actually are. I think a lot of people believe that the 3s and 4% is normal because it was there for such a long time. It takes a while. What's helped, it's not a good thing, but what's helped is the volatility in the market, you know, going from 6 1/4 one day to 6 3/4 and things like that. That's helped people realize, like, listen, we can't bank on this. But I don't think anybody's used to it just yet. And I think by the time they get used to it, we'll probably be on that downtrend.
I have a follow-up question, but I'm going to wait until you get done with your presentation.
Well, do you think that getting used to it is really going to be mostly for the people who don't currently have a mortgage?
I think it's everybody across the board. Remember, interest rates aren't just for people that have a mortgage that are looking to buy too. Interest rates affect the current liens that they have on their homes, and right now we're running at high debt levels, and people are carrying 22 and 24 and 26% interest rate on these credit cards, and they can't do anything because they're so scared of touching that low rate. It's actually costing them money in the long run. So I think it's just a matter of rates just move too quickly, and it's normally a slowly progressing process. And because they move so quickly and so violently, people are having a hard time digesting it. And unfortunately, making decisions based on interest rates. In the next couple of slides, I'm going to kind of illustrate why that doesn't make sense. So tacking on to what Bobby said earlier, it's almost like he saw my slides today, but he did not. These are the top 3 counties in New Jersey. So again, there's data out here, and this stuff is available to you as clients. You know, I don't just sit there on the phone with my clients and just hypothesize constantly. Let's look at the real numbers and make educated decisions. So if you want to know what's going on in your particular market, now I'm focusing just on New Jersey right now because that's where I primarily do most of my business, but this information is available everywhere. And if you just notice, in Middlesex, New Jersey, for instance, we're looking at forecasted 4.21% appreciation year over year. So taking the median price of a home at $493, and median means half the houses are selling above and half are selling below. It does not mean average. If you were to buy a $493,000 house, in 5 years, you have about $103,000 gain on that investment. So just taking that box, for example, let's just say this house is on the market for $493,000. There's very high demand for it. It becomes a bidding war situation like many homes in New Jersey are right now. You could justify, and this is why we show it to our client, you could justify, hey, listen, it may be worth $493 today, but you know what? I'm going to be here for 6, 7, 8, 9 years. I could justify paying more than value right now, maybe 518 for it, because in the long run, I'm going to see that appreciation. Now, obviously, when you're in the short run, it changes everything. There's more risk when you're in shorter durations. As you take the duration out longer, there's less risk. And this is a very conservative approach as far as appreciation at 4% versus historical appreciation. As you can see, 5-year historical in Middlesex County is almost 8%. 10 years, it's about 5%. And at 63 years, it's just about where we're forecasting it to be. So you get an idea of how strong the market is going forward. And it helps you make decisions when it comes to putting in an offer. So you're not just out there with emotion and just flying blind, for lack of a better word. I have Bergen County up here as well, and I have Essex County as well. And as you can see, all these numbers are healthy numbers for appreciation year over year. So you'd be very hard pressed to find anything that hints towards a market crash or buying real estate not being a good choice. Again, long-term in duration. So low inventory, high formations, Q3 and Q4 market outlook. Nationwide appreciation is forecasted at between 4.5% and 5%, and you will continue to see household formations to outpace completions, which means demand's going to remain high and inventory is going to remain low, and hot markets to remain significantly competitive. So I want to get into the numbers as far as case studies go. So there's a lot of people that want to get into the investment game and own an investment property. So I'd like you guys to kind of just be involved a little bit and kind of weigh in. Let's take an investment property, 2-family property in Essex County. This is a property my client recently brought to me earlier this week. Sales price of $750,000 with a 25% down payment and gross rental income of $6,000, taking in a vacancy factor of 8%, which means just assuming that 1 month out of that year, you're not going to have a tenant in there. So make sure rental income come out to around $5,520 a month, and you have expenses, which includes your taxes, insurance, and mortgage payments, $6,030, meaning your year 1 monthly cash flow is negative $510. And over 10 years, you're looking at cash flow of $18,000. So just by looking at this, you're putting about 25% down, about 187, right? Negative cash flow of $510 a month, and you're making about $18,000 in 10 years. Just looking at this, guys, I'll put Bobby on the spot. Is this a good investment?
I think all investments are relative to one another.
Mm-hmm.
So I think looking at it, just by itself.
Yep, by itself.
But it's tough to say, yeah, that's a great, that's a great investment.
Yep.
But when you start to look at, across board over the 10-year period, the tax benefits that you're going to get.
Yep.
It's not a bad investment.
Okay.
I think it's crap.
Okay, and Jordan, you're with 90% of people. Most people, when they're purchasing investment property, cash flow is super important. And the golden rule for many years was like, listen, if you're not cash flow positive, just toss it off to the side. Because of interest rates and because of prices right now, this is kind of what you're seeing. But it doesn't mean it's hopeless. And we get to the next slide. Now, we do all this. I have clients that put together spreadsheets, Excel spreadsheets, because they want to figure things out. This is what I call the glass half empty approach. We take into consideration mortgage payments, a 3% annual rental income increase, 2% annual increase in taxes, and about $3,600 in annual maintenance expenses on this particular property. And Jordan, I know you love stuff like this. And if you just notice, this is just showing you what the numbers were that we talked about on the previous screen. You're looking at negative cash flow in year 1, $6,100, and obviously it goes down as rents go up. And then you get to where you're at year 10, where you have $10,000 cash flow. So, I mean, there's not a lot of cash flow here, but this is the reason why I call this the glass half empty approach is you're just looking at one side of the transaction. You can't forget your powerful friends, appreciation, amortization. In that same scenario, the appreciation gain in 10 years is $351,000. Starting value of the home was $750,000 that we bought. It appreciated based on historical numbers. It's appreciating 3.92%. And its estimated value after 10 years is $1.1 million. You bought it for $750,000. So you had about $351,000 appreciation gain here. You also were paying down your mortgage, which is amortization. These are very important numbers, and you can't forget these. Your original loan amount was $562,000. Your remaining principal balance is $490,000. When you add those two numbers together, you had a return on investment of your down payment of 188%, and that's compounded at 11.2% rate of return. Now, when you look at it this way, it's a little bit different. So what this really means is that if it's almost like putting money in savings, okay? You get your negative cash flow $500 a month. What if you put that $500 a month towards the cash flow of the property? Because your intent is to get this big 188% return on investment, or 11.2, all based on historical numbers. And this is what the big guys are doing right now. When you hear about these big investors buying, there's no secret to getting cash flow. Rent is rent, right? And your mortgage payment is your mortgage payment, unless you don't have one, right?
Well,
and 25%, that's a lot of money.
The secret isn't necessarily the getting the cash flow, because the beauty of real estate is that you have somebody else who's paying your mortgage by giving you the rental expense.
Right.
So really your exposure at that point, besides the debt, which basically other people are somewhat carrying, is the initial investment that you put in. Right. Where you really need to be careful as an investor are the people who go in and they don't have cash flow in other places. And then they create this, and that's why, you know, a lot of variables depend on whether or not this is a great investment, because you need to be able to carry yourself through the times where liquidity pinches happen, because it's not only the negative 6,000, it's what happens if the HVAC goes, and now you have to put a $10,000 unit in and get the labor in, you know, with the labor and the unit and everything. You have to have that flow.
Yeah.
So
and
if
don't
you
get
have that, then you're in a good spot. But where you don't want to be is, my only investment is a rental property that I think is going to be fantastic investment in 10 years, but I don't have anything else to subsidize my investments, or my emergency fund, or my savings, or my cash flows, you know, from other places. That's where that becomes hairy.
Yeah, and please don't misinterpret what I'm saying as me saying, hey, listen, go all in on real estate. It's not what it is. It's just showing people a different side of things. I have clients that come to me and they're super frustrated every time we run numbers on these investment properties. They want to get into real estate. They have diverse portfolios, they have money other places, and they want to make some of their money work in real estate. But when they see the negative cash flow, they automatically turn on the off switch. And this is just to show you that you shouldn't turn off the off switch. If this is the right thing for you, or if this is the right avenue to go based on your other investments and things that you have, then you have to understand this is something you have to consider. That's all.
Well, Donnie, I'd add one more thing that you didn't have in there, which is there's often a pretty good tax benefit on the income that you're making and some of the expenses that you can depreciate out while you own that property. So often with real estate, when you're, as Bobby was saying, if you're not a high income person, those tax benefits don't have as much value. But as you move up and up in the income scale and your marginal tax rate moves up, owning real estate and using some of the tax advantages that real estate ownership can offer can help that cash flow. If it's positive, negative, it's negative and you're a high earner, you're not that concerned. If you're a high earner and you can use some of those depreciations, that is something that's of great use to you. So, you know, there's some benefit in there that you didn't touch on. I think what Bobby was also mentioning is not all returns are the same. If I get a liquid return in money market of 5% and it's available anytime and the value doesn't change, that's a very different 5% than an illiquid investment in real estate, or even a liquid investment in stocks, which are going to fluctuate a lot. So how you think about that those are all factors that need to come in. And that's what makes this stuff complicated. And that's why professionals like us exist, so we can help clarify these things, because most people say 5% is 5% is 5%. Right. But we all know it's very different when we actually go out and see it in reality.
I'm going to add another layer of complexities. If you're a business owner and you put this into an LLC, and then you can also create yourself as a real estate professional. I'm not saying a licensed real estate broker or agent. I'm saying if you can identify through the IRS as being a real estate professional, because then there are also tax benefits on the income that you earn in that space. So, you know, real estate does provide these nuances where there are benefits that you can't get in other places, but you can't play the big boy game unless you're a big boy or girl. When people try to go in and they don't have the cash and they think that this is the greatest investment that they can do because this is what their grandparents did, that's when people get themselves caught.
Yeah. And if you notice on the last 3 slides, and I wrote it in there so I didn't forget, is something missing. I didn't mention interest rates at all there. A lot of people just weigh their decisions heavily on interest rates. Forget interest rates for a second. Yeah, it's important, but let's just look at the returns and see what makes sense before we just take ourselves out of the game and out of the running because interest rates just don't sound attractive to you. Which takes me to my last screen. So kind of just wrapping things up, here's some tips for success if you're in the real estate game this year or in the future. Number one being interest rates are temporary, okay? There will be an opportunity in the future to refinance. Two, asking price doesn't necessarily reflect real estate value. Value is determined by demand, and asking price is a starting point. This is one of the toughest things that home buyers today are dealing with. Asking price is really just a starting point. And the best advice I give to my clients right now is that you have to put yourself in the position of the seller if you were selling a property. If your listing agent tells you, listen, this is the price that we should market the property, you have to get the most eyes on it to bring in the most buyers and get the best bidding war started and get the biggest bang for our buck, you would do the same thing too. So it's a win-win for sellers, but it doesn't mean as a buyer you don't have a good shot at it. You just have to have the right data. You have to be asking the right questions, and you cannot be going into this with emotion and determining value on your own. If you are going to put a value on something that does not reflect what the market is, it's a losing battle.
Well, Donnie, that's where I'm going to throw you another plug, is the fact that you need somebody who knows this market by your side, who's going to help to rationalize some of the things that happen in the transaction. And if you don't have that person, you're trying to do it on your own. You had said earlier on, let's not look at this emotionally. It is a very emotional purchase for most people. Even investment properties become very emotional. They get all caught up with the sexiness of the transaction, of the purchase, of the investment, even more so when it's the primary resident. And having somebody by you that can keep you grounded is it's huge. And not just somebody who's going to sell you a product.
I'm so glad you said that, because you cannot put a price on the value of a good full-time realtor that understands their market right now. I have many clients that use family and friends and people that they know that, yes, they've been in the business a long time, but if they're not active in this market, it could cost you thousands of dollars if they don't know how to put together the offer correctly or guide you the right way. And we're seeing it. Clients that are working with professionals that are full-time, that understand their markets, are having offers accepted much quicker with less pain than buyers that are going for the latter. So realtors are really earning their bucks right now, and it's super important to interview and make sure that they understand the market and they're currently active in this market. Number three, making an offer. In hot markets, that properties that are listed for less than 10 days, they often go above asking price with only one chance to bid. All right. If a property is on the market for more than 10 days, you may have an opportunity for initial offers and counter offers. So keep that in mind. You look at how long the property has been on the market before you start throwing things out there, because you don't get a second chance a lot of the times. Number four, every mortgage and property is unique. So don't make comparisons or decisions based on other people that have done it recently, and run the numbers and make decisions based on your goals, risk tolerance, and qualifications. As you can see, I get pretty nerdy with the numbers. And I try to simplify as much as I can for the customer so they understand it. Now, whether they listen or not is a whole different topic, but you need to have the numbers to be competitive. And number five, news is often lagging and tends to sensationalize fear. The media tends to get it wrong when it comes to real estate. National numbers may be out of touch with local markets, so it's really important. The media talks about median home price going down, but again, that's a national number. They're talking about reports that are a month old and they're dated and things like that. You have to get specific with your particular market. And remember, don't just read the headlines, because it can be very misleading. That's all I got for you guys.
I think that was super helpful, Donnie. I think,
Cool.
you mentioned a couple things there, which should certainly be food for thought. Some of the highlights that I found were, one, I think people are way too obsessed with trying to guess and predict this interest rate market, and that's probably not going to help them. They should focus a little bit more on the things they can control and not the things that they can't control. I think you said another thing that I think hits home for me, a choice that me and my family made, which was, make sure you use a really, really good real estate agent, mortgage professional. Like, make sure your team around you as you're going through this major purchase and major decision, make sure you have a lot of confidence in that team. That's super important, I think, as you as you go through the process. Even in the example that you put up about investments, not everyone's going to interpret the quality of an investment the same way. And sometimes it helps to get a couple different opinions on it and just to hear what people are thinking and why they think it's good or why they think it's bad. Make sure that group isn't, just the guys having coffee, at your local deli or, favorite breakfast spot. Make sure a couple of those guys have credibility and credentials where they're going to help you look at it from a different perspective. And of course, look at the data, look at the history. Don't just assume that the last 5 years is representative of what the actual climate and environment had. And those were some of the key things that I heard. Are those some of the key things that we want to have viewers take away, or did I have
love
a
it,
new
man.
perspective?
No, you did a great job at it.
I think the only
Just
thing
like-
I would add is that, your primary residence is not to be looked at as solely for investment purposes. That if you really find the house that you want, you have to figure out what it is that you value that for, the cost that you're willing to put toward it. Because I think a lot of people tend to chase these rising markets and they wait until the last possible opportunity because they're fatigued. They throw in the towel. They go, this is just going to be it. And they don't end up with the house that they want. They end up with buyer's remorse. They end up spending more than they should have. And then they end up finding themselves in a transaction that they're later going to try to unwind in a shorter period of time. And that bigger picture really needs to be taken into consideration when you're going to be moving yourself and your family and into a place that you're going to reside for a long time. So
it doesn't have to be an exit. It doesn't have to be as anxiety filled as people think, but you do have to be disciplined, and you just have to get the information from the right sources, and it can be a lot easier for you. And family tries to chime in and help a lot, but sometimes it could cost you a lot of money because, again, markets change, and this is a very different market that we're in these past 2 years than ever before. So I don't care how many times you purchase a property, if you haven't done it and you haven't been in this game the past 24 months, it's different. So make sure you have that team that you're confident in.
Donnie, I have a quick question. What are some
Yeah.
of the factors that current homeowners should consider as they're looking to refinance? Is there a certain interest rate level, say they locked in at 6.5%? When's the magic moment to look for that refinance? What are some of the considerations that should go into making that decision?
It really comes down to the numbers. If you're talking about straight up refinance and we're not taking other debt into consideration, you just want to make sure that the savings that you're going to realize from the refinance makes up for the closing costs that you're putting out of pocket in a certain amount of time. I believe that we're probably going to be in a market where we're going to end up refinancing 2 or 3 times in the next 24 to 36 months. Yeah. So if it makes sense and you could break even at a certain time, again, the more you borrow, the 0.5% makes a big difference on $700,000, where 0.5% on a $200,000 mortgage doesn't make does not put a big number on it. But one of the things that we do is we're tracking this for the clients. So my clients are going to get an email from me saying, hey, listen, this is what the savings are as of right now. So they'll have the numbers in front of them and they could pull the trigger. But I would say every time rates move around 0.5%, you should be asking questions if your mortgage professional isn't reaching out to you, which they should be.
So Donnie, we're reaching the hour mark. Tell people where to find you, and tell people what if you get them if they give you their email, what it is that you can kind of sign them up for and give them if they're interested in information.
Yeah, you can find me on my website, which is just my name, DonaldAnfuso.com. You could find me on Instagram at Mortgage Pro for Life. We should probably send it out. I didn't have that up on the screen.
We'll have it in the notes. Yeah, we'll have it in the notes.
I have a lot of educational content, financial literacy content that I put up there on a daily basis. And you can always reach out to me on my cell phone, which we'll put in the notes as well. If you have questions, I'm always here to help and happy to help, whether you need a mortgage or not. You can always reach out to me for advice.
Donnie, thanks so much for your time. Guys, great job on putting the presentation together for the investment committee. If anybody else has any questions or wants to, reach out to Donnie, we're going to have all of the information available to you on how you can connect with him. And until next month, guys, enjoy the weather. Happy 4th of July, and investment committee out.